For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and health care? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. Hey, we welcome you back to the program. Yeah, wow. Time to get started. Managing Your Financial Future. Johnny Dean, your podcast host. Professor Rick Plum, certified financial planner professional and accredited wealth management advisor.
You got them both.
I knew it. I've actually known this, but, I think the joke's getting stale.
Yes, it is.
You really are one of those, though.
I am. I'm both of those.
Did I say certified financial planner professional?
Yes.
I meant to say that.
You
It's
did.
not. CFP, registered trademark, et cetera, which really gives it some flair, some panache. Yesterday, welcome to the show. Thanks for joining us, folks. You and I were at a meeting yesterday, and a few other people from Lucia Capital Group, and it was a meeting of the Rotary International. I don't have the exact title. It was a Rotary meeting, is what it was. And you were the featured speaker. If you recall.
I do recall.
It was just
only yesterday.
And I want to talk about the things that you talked about with these folks, because it was very interesting. And it reminded me that number one, we hadn't talked about this for a long time. And number two, the importance of people understanding what it is we're saying here, or what you're saying here. And it has to do with charitable giving. It's also tied into required minimum distributions. It's tied into IRAs, and it's also tied into taxes. These are things
and it's tied into buckets.
And it's tied into buckets, which we're going to hope to wrap in a nice, neat little package.
Everything I do in financial planning pretty much is tied into buckets.
You really did do that yesterday as well for these people, and many of them had no idea about this particular thing that we're going to call Qualified Charitable Distributions, QCDs. If you read the title on the podcast, you know that that's exactly what we're going to be talking about and why they're so important. You said something, Professor Plum, during your talk to these people. What do we have? We had a good 60, 70 people there, right?
Okay, I didn't count them.
It was a whole room full of people. And many of them, if not most of them, were of required minimum distribution age. But you said something that when you said, but right before your talk, you said these are called qualified charitable distributions, and I cannot think of a reason why you wouldn't do this. I cannot see a downside.
If you're charitably inclined.
Right, and for
and
you...
eligible.
Well, that's true, and we'll get to that. But for you to say something like that, usually you say, well, there's a good side, and then there's another side.
It depends is my standard answer on things.
Correct, but I don't know that you're going to say that about this. So let's talk about this for just a little bit here, Professor. Now, we're not going to use any slides. You had a bunch of slick slides yesterday, and it looked good. But we can do this for our podcast audience, many of whom do not know about this because it's been a while, as I said, since we've talked about it. Qualified charitable distribution. So the deal is, Professor Plum, I'll set you up here and you can talk about it. The deal is that you want to give money to a charity.
Right, you're charitably inclined. So where should you get the money to give to that charity?
Now, oftentimes people will just say, well, I've got some money here in my checking account, and I'm going to write them a check, and nothing wrong with that. I've been doing it for years. It's a church. It's a, some type of organization, whatever it happens to be. You can give any amount that you want, and sometimes you get a deduction for it, sometimes you don't.
Well, and that's the problem. Most people think that anytime I give something to a charity, I can deduct it. But that's not the case for most seniors.
No, certainly not anymore. Not.
And the reason for that is we all get to take a standard deduction of over $32,000, meaning
married couple.
Yeah. We get to reduce our income for taxes by 32 and some change. So unless our what they call itemized deductions, our property taxes, state income tax, our home mortgage interest, our health care that is actually or health expenses, and our charitable giving expenses exceed the standard deduction, we're not really getting a deduction. Now, there's $300. I'm not going to worry about the $300. But most of the seniors, their mortgages are paid down or off. They're limited on their state income tax and property tax to only $10,000, and many of them don't even have that much of state and local income tax. And so for them to give money to a charity and have it deductible, the first $20-some thousand of that gift is not deductible if they're making larger gifts.
Correct.
So we want to find a way. And for once, there are every once in a while, Congress does something that is actually beneficial for us.
Well,
we saw this in 1998 when we got the Roth IRA.
The Roth IRA was the last one that I'd remembered doing until we got into this Qualified Charitable Distribution.
2006 gave us the Pension Protection Act, I think it was called, gave us the Qualified Charitable Distribution.
Okay, so
it allows us to get a deduction even if we don't itemize.
Yeah, and it's what we might call a de facto deduction. I'm not going to. It's not a.
It's not a deduction. Well, it's a deduction.
It is
because I'm reducing my. But it's an above the line deduction.
Okay, so
it's all these technical.
We won't get into the.
But it allows you to not pay taxes on the money that you're giving to charity if you do it right.
Right. Okay. So
if you're old enough.
So I talked about the normal thing was somebody says, well, I'm going to give $5,000.
Yeah.
Pick a number. It doesn't matter. $5,000 to this charity that I really or group of charities that I love. Normally what I do is I just write a check.
Right.
Now, what happens as people get older and they get into what's called required minimum distribution age? They say, oh, well, look at this. I'm going to use an example where somebody has, let's say, $5,000 required minimum distribution. All right.
Okay.
And just by chance, they want to give $5,000 to a charity. It does not have to match. It doesn't have to be the same. It can be more. It can be less. But so they get to required minimum distribution age. I think the normal thing that people would generally do is say, okay, well, look, I'm going to take my $5,000 required minimum distribution, okay? I'm going to have to declare that as income. That's going to be income to me.
Right.
And I'm going to have to pay taxes on that. But at the same time, I believe that if I write this $5,000 check the next day or whatever to my charity, well, I have $5,000 of income that I have to declare as income and pay taxes on. But I've also got this $5,000 going out to the charity. Now, the standard way of thinking is I have to pay taxes on that income, but I'm going to write it off as it goes out to the charity, so it's a wash. And I could think of a couple of problems with that, Professor, but you take it from there.
Well, the problem is that in some cases, even if you could write it off, you took 5, but your income went up by $9,250.
$9,250?
Yeah, and now you're getting a deduction for the $5,000, but your income's still $4,250 higher than it was before because of the taxability of your Social Security benefit that wasn't being taxed before.
Okay, there you go. That's the first problem that you have. Now, you said if it even is deductible. As we said, some people don't know that they can't deduct that $5,000.
Right, because they don't have enough deductions to meet the threshold.
Correct. Okay, so take it from there on the Social Security. Let's focus on that for just a moment.
Well, income that comes out of an IRA to you is taxable income. It's part of what they call your adjusted gross income. Your adjusted gross income is basically your income before the deductions for your home mortgage interest, your property tax, and all that, or the standard deduction. That is the basis. The adjusted gross income is the basis for determining how much of your Social Security is taxable. It's actually a modified number that could be slightly higher, but I'm not going to get into the technical sides. So if you have a higher adjusted gross income because you have a higher if you have a higher total income because you've taken distributions from your IRA, more of your Social Security may be taxable.
So you said if I take a $5,000 required minimum distribution from my IRA, you said my income is not actually $5,000 in this case; it's $9,000.
It could be $9,250.
And why is that?
Because up to 85 cents of every dollar of my Social Security could be taxable.
So how much Social Security are you assuming here?
I'm assuming $5,000 of Social Security that wasn't taxable before.
Yes.
I took out $5,000. It increased my modified adjusted gross income by $5,000, which meant that $4,250, 85% of the Social Security that wasn't taxable before is now taxable.
You see,
it's a pain in the butt, is what it is. But just it's a problem.
Yeah.
So and the other thing is, let's say I did have medical expenses I wanted to deduct. It's now a higher adjusted gross income, and my medical expenses are limited based on how much my adjusted gross income is. So I just lost some of my medical expenses. For people at the higher income levels, if I take the money out of the IRA and it shows up as part of my adjusted gross income, and even if I could deduct it, the adjusted gross income is up there, which could subject me to IRMA, income related monthly adjustment amount. Nothing good is happening here.
But wait a minute. I thought that if I take a $5,000 required minimum distribution from my IRA and I write a $5,000 check to my charity, they don't wash out.
Not necessarily.
For reasons. Let's say they may not wash out.
Yeah.
They could, but they may not.
Right. For some people, it's going to create more taxes. For some people, it's going to throw them into the net investment income tax situation for their capital gains, interest, and dividends. For some people, it's going to throw them into IRMA. And that's even if you can deduct it.
But you may not even be able to deduct it because your standard deduction is higher. Okay, I don't. So that's your scenario. Now,
so there's a better way.
So the problem is when you took the money out of your IRA and you took possession of it, it hits your income, it'll hit your tax return. That's the reverberations from that, I like to call it. The
ripple effect.
The ripple effect can send you into a worse tax situation.
Uh-huh.
So here's where the qualified charitable distribution may come to the rescue, Professor Plum.
Now, I just want to clarify. You talked about it being at RMD age. It's not anymore. It is for anybody who is age 70 and a half. And this is to the day. It's not the year you turn 70 and a half. 70 and a half or older. You don't even have to be at RMD age because RMD age is now 73.
No.
But if you are going to be charitably inclined, having the ability to move money. Now, you have to go directly from the IRA to the charity. So if you take a distribution and then give it to the charity, that's not going directly to the charity. That does not qualify as a qualified charitable distribution. That could be a taxable event to you. Now, some places, brokerage houses, will, if you say, I want to do a qualified charitable distribution, I want to give it to the university, the hospital, the church, whatever it is, they will make the check out to that particular institution and then give you the check. They will mail you the check. That is not the same as a distribution to you. The check's not payable to you, but the idea is that you get the check and then you can hand deliver the check and say, what a good boy am I.
Or woman.
Or
Okay, so that's the whole point.
But the idea is it goes directly from point A to point B.
You tell your IRA custodian, look, I've got a charity. I want to do a qualified charitable distribution. I would like X amount of dollars to go to this charity or charities, and they will
write the
check, either send it directly to them.
They can do it electronically.
Or they'll send it to you in a paper check to you. But it has to go from you cannot take...
if you take possession of the money and then turn around and give the money to charity, that's a distribution, not a qualified charitable distribution.
So how does this benefit people sending the money directly from your IRA to the charity or charities?
Assuming they account for it correctly on their tax return, which we can get into later.
Right.
It does not show up as part of your adjusted gross income. So it doesn't increase your income for determining the taxability of your Social Security. It doesn't increase your adjusted gross income for the net investment income tax. It doesn't increase your income for the income-related monthly adjustment amount, IRMA, for Medicare taxes.
It has no effect at all on your income.
It doesn't show up. So it's as you mentioned earlier, it's a de facto deduction because it doesn't show up as income to begin with.
That's exactly right.
It used to be thought of as an RMD play. And it still is, but it's not linked exactly. It satisfies the RMD.
The required minimum distribution.
It can offset the required minimum distribution. It doesn't have to be the required minimum distribution.
Understood.
If my required minimum distribution is $40,000, but I don't want to give $40,000 to the charity, I can give 10 of it, and then I have to take another 30 out myself.
All right.
But it counts towards my required minimum distribution. The reality is, the qualified charitable distribution can be any amount you want to do once you're 70 and a half or older, from $0 to $105,000 in 2024.
You can't really give zero, so we'll say from $1.
$1. Okay, from $1. And to be honest, if you're doing it for $1, just give it out of your pocket because I don't want to do the paperwork to get this done for $1.
Understood. But up to $105,000 per.
It was $100 last year
person.
Per person. So if you've got a married couple, each of them can do this.
Yeah.
But here's the kicker. When you get your 1099, the 1099 is the tax form that the IRA custodian is sending to the IRS and to you, telling you how much money you've taken out of the IRA for the year.
How much money left the IRA.
How much money has been taken out of the IRA. There is no code. There is no explanation. There is nothing on the 1099 that says this money went to a charity. It is all being coded, treated as a distribution to you. So in my example, my $40,000 RMD, I gave 10 of it to the charity through a QCD, and the other 30 came directly to me. I'm going to get a 1099 that says this is a normal distribution of $40,000. And so if you are of the ilk where you just gather up all your tax forms, hand them to a tax preparer, and walk away, and the tax preparer doesn't know
that it's a QCD,
that it says QCD, you may be paying tax on that money.
So
make sure you tell them. I know that one of the most popular tax softwares, once you are 70 and a half.
The one that does the turbo sort of.
Whatever.
All right. Sorry. I didn't say anything.
Once you're old enough to
be
eligible, it will ask you. So it'll say, you put in your 1099, and it'll say, did you do anything special with this money? Like give it to charity?
It'll do it for you.
Yeah, it asks you the question.
Yeah.
So you just have to answer the questions. But otherwise, you end up paying tax on it, and you shouldn't. I mean, and the whole idea is, if you're charitably inclined, which is wonderful, we want to make it as efficient as possible for you. We want to be able to, because the only thing we're doing here is reducing the amount of taxes that you would ultimately have to pay. And sometimes you can reduce them more than you think. But what does that do? Okay, it reduces an expense of mine, an expense I don't want to have in the first place, an expense I really would like to reduce. And it either gives me more money to deal with, or it gives me more money I can give to the charity. So either I win, the charity wins, which means I win. The only place that's getting somewhat shortchanged is Congress. What a shame. What a shame.
Does this work on the state level too? I mean,
yes, it does.
So you're
yes, and so it's eligible for anybody who's 70 and a half or older. And one of the interesting things is, if I'm 70 and a half or older and I have inherited an IRA, usually with beneficiary IRAs, we're kind of limited. We can't do rollovers, we can't do conversions, we can't do a lot of things, but we can do a QCD. But I have to be the person who I inherited from. Their age doesn't matter anymore. It's my age that matters whether I can do a QCD.
So if you're 65 and you inherited it from a 90-year-old, you can't do it until you're 70 and a half.
But if I'm the 75-year-old and I inherit it from a 65-year-old, I can do a QCD even though they weren't old enough.
Yeah, look at that.
Hey, got to look for that lemonade.
That's right. That's right.
So charitable giving is part of what a lot, especially seniors, do a lot of charitable giving. Maybe they go to church every week and drop $100 into the basket every week.
Wow.
And so that adds up. And what is that? That's a $5,000 plus, if they go every week, $5,000 charitable donation that they make every year. Instead of dropping $100 in there, do a QCD for the $5,200. And that way you get the tax deduction for it.
Yeah, I mean, why not? Everybody is kind of winning. I don't like to use the word win-win because that's not really compliant, number one. But number two, I mean, the charity gets the benefit.
Right.
You could potentially get the benefit.
Yes, and so that's what you want to have happen. And it reduces our overall taxation. And that's a goal almost of everybody, I think.
I would hope so. And this is why you said you can't see a downside to doing it. I mean,
the only downside, as I explained yesterday, was for that person that gives $100 every week, they don't get. People can't see them putting the money into the basket.
When the basket goes by, you pass it on. And you can just
you're not getting credit.
I have a QCD.
Yeah.
You know,
honest, really.
Can you put a little? You could make up a piece of paper and stick it and say, "I gave it the office." I gave it the office. Yeah, just make it look like that. That got a good laugh, by the way. Yesterday.
That's the only downside I can see. In every other situation, if you're eligible, I can't find a downside. If you're going to be charitably inclined and if you have an IRA, do it this way.
Yeah, and this works, I mean, regardless of whether or not, I mean, maybe the QCD, maybe doing it this way doesn't benefit you at all. Maybe you could have taken the money out of your IRA and taken possession of it and then written a check the way I described at the top of this podcast. But the QCD wouldn't have helped you. I mean, there are instances, but why not do it that way?
That's a very rare instance, by the way. In most cases, it's going to help.
Is that true? Really?
I'm having a hard time finding instances where it would not have worked. At different income levels, it's affecting that adjusted gross income number is affecting other things. And as I said, most seniors are not using long form anymore.
That's interesting. Yeah. Now when you talked about the most common, I would think, that people do is they give money to their church every week. You know, you go to the service, you throw some money in, as you said. You had suggested to do this maybe once per year or whatever.
Yeah.
Once a quarter, once per year can work.
It's paperwork, so don't do it every week.
No, don't do it. No, but let's say you do it once a year. Is it better to do this at the beginning of the year, at the end of the year? We've talked before about when to take your. This is an RMD play when I'm talking about it this way. But does it matter?
It doesn't matter from a tax standpoint whether it's January 2nd or December 30th.
Yeah,
I always give a day at the end of the year because things don't happen on those.
Could be a weekend. I mean, Sunday, right?
Yeah.
You're giving
as long as it happens during the year.
Yeah.
Now it's just a matter of when do you want the charity to have the money.
Okay. All right.
And things like that. And obviously, in that respect, if you're using your, more than your RMD and you're actually using your IRA, where you're not worried about the RMD ever hurting you, leaving it in towards the end of the year, that maybe get some more qualified charitable distribution. One thing I just thought of, if you have an IRA that has after-tax money in it, you rolled over some after-tax money, you contributed after-tax money or something, the QCD. Normally, if I have an IRA that has pre-tax money and post-tax money, after-tax money,
it's prorated.
Any distribution that I take is based on the percentage of the overall IRA. QCDs come 100% from the pre-tax money.
Oh, did you mention this at your talk?
I didn't. I should have.
That would have been great.
But
okay, well, I don't know how many people have post-tax money in the IRA, but and this only works from an IRA. This does not work from a 401k.
It does not work from any other retirement account.
It has to be an IRA.
And somebody asked me if it works for a Roth IRA. I said no, but it doesn't matter because it's tax-free anyway.
Roth doesn't show up.
And like I said before, though, it does work from a beneficiary IRA, which I thought was fairly interesting.
Yeah.
But it's if you're going to be charitably inclined. Now, when it comes to being charitably inclined, many times sometimes it's a one-time thing that you do, and others it's an ongoing. Most of the time, it's kind of ongoing. It's going to you're doing that $100 a month or whatever the number is, or every year you want to give $5,000 to the San Diego Zoo because they're a nice beneficiary of that kind of thing. Just different things. If it's every year, now you have to build it into your cash flow. You don't want to have to worry about, the stock market's down this year, so I can't give you as much. Well, that's not a fun statement. It's just like the stock market's down, the old 4% rule, I need to spend less.
Yeah.
Well, I can't give. I would like to be able to give the money every year because I want to give the money every year, and I don't want to ever have to sell anything when it's down.
Correct.
To create the money to give them, or just give them the stock when it's down because they don't get as much.
So what do you do?
It's part of your overall strategy, your income strategy. The income strategy should be satisfied by having an appropriate bucket strategy.
So how do you work this into a bucket strategy? What do you do?
It's part of your expenses. At that point, it's becoming part of your expenses.
So as you're working we'll call it your short-term expenses for the year.
Yeah.
All right. You're working this charity.
Well, like you're saying, I'm going to give $10,000 a year to charity every year.
So that's another $10,000 you need from
as
bucket
part
one.
Of my bucket one, as part of bucket number two as well.
Yeah.
We just need to build it into the overall strategy, unless you want to. Unless you don't care about the volatility. I'm going to give them 1,000 shares of Apple every year, or something. We'll just give them what it's worth is what it's worth. So it depends on how you're treating your charitable giving.
So you would arrange somebody's IRA as you would bucketize the portion of this IRA, correct?
Right.
And you would take it out of the bucket one portion of the IRA.
We would bucketize the entire place,
right? Yes,
entire
including the IRA,
to provide the overall income. But also, when we're doing the location to do the taxes, we know that portion of it is not a taxable event, so we're going to be taking that from the IRA. So it's just a fun way to play.
Well, yeah, and regardless of whether you're doing QCDs, I mean, you should have the bucket strategy anyway, because you don't want to be in that position where, gee, the market's down, I can't give my $5,000 or $2,000
or whatever
the amount is that you want to give. You can also, if your required minimum distribution is $5,000 or $6,000, you can give more than that through a QCD.
The QCD is any amount you want, regardless of what your RMD is, up to $105,000.
And as that goes up every year?
It does now. It hadn't when they first brought it out in 2006. It was $100,000. It's been $100,000 for the last X number of years. Now it's going to be indexed for inflation thanks to Secure Act 2.0.
It's a good deal, quite frankly.
If you want to give money to charity and you have an IRA.
Now, don't flip this around if you're not charitably inclined, but you're thinking you're going to save some taxes this way with your RMD. Professor, it's not really going to help you. It'll help the charity.
If you're not charitably inclined, making a charitable gift to save taxes is kind of stupid?
I don't want to say it's stupid. The charity, I mean,
Well, no, but if I didn't want to give the money to the charity in the first place, and I'm only doing it to get the tax deduction.
No.
Even if I'm in a high tax bracket, let's say you live in California and you make millions of dollars, I'm going to give $10,000 to a charity so I can save $5,000 in taxes. I'm still out $10,000.
That's true.
If I'm charitably inclined, the tax deduction helps. But if I'm not charitably inclined, it doesn't cover.
So it is part of your overall bucket strategy in this
believe,
instance, and you can set this up any way you want. If it's just part of your, as you said, part of your short-term expenses. So is the process easy? I mean, if I say, oh gosh, these guys are talking about this on this podcast, I think I need to start doing this.
Sure.
What do they have to do?
For us, buckets are easy.
Well,
we do buckets every day, and we do QCDs. Maybe
so
not every day, but there is paperwork involved. It's just a matter of doing the paperwork.
So you tell your financial advisor. Oh, I would think your financial advisor would know that you're.
I was speaking to somebody after the luncheon yesterday when I was speaking, and he's saying, "Okay, so can I do this and then have them do the tax withholding later?" And I go, "What tax withholding?"
Yeah.
And he's saying, "Well, I do. I tell them I'm going to give this money to charity. We do this and this and that, but then we have to do the tax." I go, either they're doing it wrong or I'm hearing something wrong, because why are you doing any tax withholding on a QCD that doesn't cost anything in taxes?
Yeah, there should be no taxes on it.
And he's like, he wasn't sure what his broker's house was doing.
This shows the importance, though, also of understanding what happens when you give money to charities, and where that money comes from. You know, on an overall bucket strategy too, Professor Plum, you mentioned this as part of what we call asset location, right?
Yeah, to a large degree. But charitable giving is just part of life for a lot of people. They do it every year.
I saw this at this Rotary meeting yesterday. My goodness. I mean, they passed the hat around. You know, somebody had asked for, they were trying to raise funds for a
trip to Legoland.
A trip to Legoland for I think
kids
it was
with autism.
Autistic kids, right. And I think they needed $3,200 or something like that. And I mean, these people just came through. I think they gave
raised
the whole thing.
Yeah.
I mean, just passed the hat around. So there are a lot of people around there who
they're very charitably inclined.
Yes, and this is kind of what they live for. But what I don't think some of them, I don't know how many of them, understood that, you know, this gift, as you said, may not be deductible. This is a way to do it.
Right. Now, in the gift, when they passed the hat around, the recipient wasn't a 501c3 charity, so they wouldn't have been able to get a deduction for that. So they don't use a QCD for that one.
No, it's not.
But they should be using QCD for anything that is eligible.
It impressed upon me how charitably inclined so many people are, and how far behind I've fallen in that particular. I'm looking around, I thought, my gosh, these people are, you know, really? I mean, I think one person said that however much we don't raise today, I will give the rest so that this person gets the $3,200.
Whatever the hat doesn't have in it, I will fill it to the $3,200.
Right, but you folks fill
it to the rim with
with brim to the brim. No, you're right. Yeah, is that stuff still around anymore? I don't think it is. Showing our age again. Well, Professor Plum, this is a fascinating discussion. I know.
I just wanted to finish on one part.
Yes, please.
Charitable giving is something we do during our lifetime, but it's not something that necessarily stops when we do. And so we want to make sure that our estate plan and our passing on to the next level is coordinated with what we want to achieve. And a lot of people do a lot of legacy planning, and they give money at death to charities. That's when they don't do it while they're alive. They do it when they're dead,
right,
which is fine.
Yeah.
But I've seen where it's not done very efficiently. They may leave their stock portfolio to the charity and their IRA to their kids. To me, if they're equal value, that's backwards, because the stock portfolio gets a step up in basis. The kids can inherit that pretty much tax-free, where the IRA, if the kids inherit it, they're going to pay taxes on that IRA, and now they have a 10-year time horizon to get it out. If we give the stocks to the kids and the IRA to the charity's not going to pay any taxes on that IRA.
That's the only instance where you don't pay taxes on money come from
out
of
an IRA,
right?
Yeah. And so coordinating and being able to set it up appropriately can save taxes not only during your lifetime, but when you pass away for your heirs too.
Yeah, it's an important fact to note. I'm really glad you brought that up here. That your estate plan needs to be is
coordinated with your beneficiaries, coordinated with your wishes.
Your overall,
it's got to be all coordinated.
Overall financial plan should have that. And if you've talked to your financial advisor, even if they don't do estate planning, you need to tell them, hey, this is part of my whole estate. They can work it out that way. Did you know, Professor Plum, that we have an estate planning kit? Guide. I'll call it a guide.
It's a guide.
An estate planning guide. That's what we have. Available for folks who want to download this. I try to mention, we have several guides. Since you mentioned estate planning, we're talking about QCDs. I don't know if QCDs is in there.
We have a bucket plan too. No, it's been a little while since I read it.
I'd have to check. But anyway, we have this. You go to luciacap.com, LUCIACAP.com. Search bar up top, you just type in estate plan or estate planning, something like that, and it'll be the first thing that you see. Click on that. You can download it, totally free, of course. It's a comprehensive guide, but it's kind of in plain language.
As plain as it can be.
As plain as it can be, yes. Read it, and some sections may apply to you, some may not, but read as much as you want. And these kinds of things are important when you go to meet with your financial advisor. These are the things that you can talk about with your advisor. So as we said, it's all coordinated. Download your free guide at luciacap.com.
There's a buckets guide there too.
There's a buckets guide. If you type in bucket strategy or just buckets, I think, try bucket strategy. There's a free buckets guide too.
Yeah.
Yeah, we had a bunch of them. People, they were kind of popular yesterday. We brought those with us up to the Rotary meeting as well. So I should say thanks to those. I don't know how many of them listen to this podcast, but it was they're a wonderful group of people. I've been to several meetings myself, and I know we have a couple of people here at Lucia Capital Group who are members, and they go every week. And so I'd like to see you give more talks if you're if you're inclined to do so. Hey, you got a nice
inclined to listen. Yeah.
You got a nice lunch too, which was good. So
that works.
That does work. My thanks to Professor Rick Plum. If you have questions on this kind of thing, if you want to know more about QCDs, Qualified Charitable Distributions, you can get in touch with anyone at Lucia Capital Group, 800-644-1150, 800-644-1150, or go to the aforementioned website. We got a lot of stuff right there, luciacap.com. You can download, as I said, the guides. You can also watch videos and all that kind of stuff at luciacap.com. Anything else you want to add?
I just want to say, sorry, Bruce, you've never invited me to the Kiwanis meeting.
That's a friend of yours.
A friend of mine. He's going to be like, wait a minute, you went there?
Hey, there's an open invitation. You can talk at Kiwanis. There's, you don't care. Elks, how about the Elks Club? You could do that.
Yeah. If they want to learn about QCDs and stuff.
Anybody who wants to do that, yes. Beyond that,
I'm pretty cheap. Free lunch, and I'm good.
That's what I was going to say. Yeah, free lunch will get you just about anywhere. My thanks to Professor Rick Plum. I appreciate you being here as always. Next week, you mentioned something about inherited IRAs.
I did.
Just briefly. Well, you just talk about inheriting IRAs.
Yeah, because you can do a QCD from them.
Exactly. I want to focus on that discussion next week on our next podcast. There's some new rules, but new guidance. Or continuing guidance.
And it was something I didn't think was going to happen because I thought the IRS could actually get on the ball for a minute.
No,
and I was wrong, and
they're still in the huddle.
Yeah, they're still in the huddle.
They've called timeout. Yeah. They're going to we need a little. Yeah,
so we're going to take a break here for a minute.
We'll talk more about that next week. Some strategies with inherited IRAs. So that's some good stuff. Thank you, Professor Plum, as always, for this guy, Professor Rick Plum, certified financial planner professional. I'm your podcast host, Johnny Dean. Thanks so much for listening. It's Managing Your Financial Future. Talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you're required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax.
Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.